evening, ladies and gentlemen. Welcome to MBFC Tower 3. We are very glad to have you with us today and at this RQM evening session. This is the second session of our RQM evenings. So we are very glad and very honored today to have with us Mr. Mark Mobius, a man who needs little introduction. And I'm sure you will enjoy this evening with us as he shares with us his insights into the Asian economies. So thank you. Thank you for joining us tonight.
Thank you, Cynthia. As you've heard, Dr. Mark Mobius is a man who needs very little in the way of introduction, but I will say a few words. He's chairman of the Emerging Markets Group at Franklin Templeton Investments, one of the largest fund managers in the world. He joined them in '87 to run their emerging markets activities, so he's been there for 25 years. He's been investing in emerging markets for longer than that as well. Over that long career, his name has become synonymous, I think, with emerging markets and how to invest in them. And so we're delighted to have him with us today. As I mentioned, we've asked Dr. Mobius to talk about Asia in the context of the world. And I think if you look at Asia, it's clearly a region of the world which is growing much faster than anywhere else. It's a region that has much sounder finances than most other places in the world. And its weight in the global economy is clearly rising very sharply. But all of this is now sort of conventional wisdom. People know about Asia. They know that Asia is exciting, and they know about the growth here. And so consequently, we've seen prices for assets go up in the region and reflect the fact that this conventional wisdom has become more widely known. And so the question we really wanted to put to Dr. Mobius today is, as you look around the world, is Asia still as exciting as an investor as it always has been? Or in relative terms, are other places like perhaps Africa or Latin America or indeed Eastern Europe or Western Europe and America regaining some relative attractiveness compared to the opportunities that we see in Asia? So on that note, to share his thoughts, let me invite Dr. Mobius to join us. Thank you.
There's a realization, first of all, that emerging markets are growing at an incredible fast pace. Even with all of this negative news about Europe and so forth and so on, the reality is that emerging markets are now, on the average, growing at 5 times faster than the developed countries. 5% average growth for emerging markets this year. China, you know about, but it's not only China, it's India, it's Brazil, it's other countries. So that's one thing that's beginning to sink in to investors in America and in Europe. The second thing is that the debt levels of emerging market countries is much less than that of the developed countries. The debt to GDP ratios of these countries is way down. In Asia, of course, you know, we had the Asian financial crisis, and that scared a lot of governments to, you know, tighten up, not spend so much, not to borrow so much, particularly in US dollars. So that helped. But it was also the realization that they wanted to, you know, really put their economies on an even keel, so they didn't spend as much. So government spending has been more moderate. So you have a big gap between emerging market countries and developed countries in that regard. The third thing is that foreign reserves in emerging market countries have been growing at a much faster pace. Starting in 05, 04, 05, you saw the gap widening. Emerging market foreign reserves going up, developed markets sort of increasing a little bit and then slowly falling down. So 3 things: the growth rate, the debt, foreign reserves. These things are very, very important for rating agencies and people who are looking for safety. So gradually, the prejudice that people have against emerging markets, because, you know, they read, oh, there's a riot in Egypt, or there's something happening in China, so forth and so on, gradually they are overcoming these prejudices. And we're seeing, therefore, flows of funds coming into emerging markets in a growing pace. Now, the other thing that's happened, of course, is that with the Fed in the U.S. spending money as fast as they can, buying up pretty bad instruments, mortgages and so forth, and pushing interest rates down to very low levels, there's an incredible search among institutional investors as well as private investors for yield. Because if you're a pension fund, you are now subject to redemptions. People want their pensions. The U.S. is an aging population. Europe is really aging. You need yield. Where do you get yield? 1% for U.S. Treasuries or less? You begin to look at emerging markets. You begin to search for these countries that may have a perception a little bit more risk, but if you look at those three factors I mentioned, maybe not so bad. So we're beginning to see a shift into these emerging market countries. And one of the good indicators, by the way, of looking at Asia and emerging markets generally is the difference, the gap between emerging markets, debt, interest rates, and U.S. Treasuries. If you track that, of course, during the subprime, bam, it goes up. You know, the spread goes very wide, then it came down. And the stock market just does the opposite. Stock market goes down when the spread goes up and vice versa. You'll see that spread trending downward, which is an indication of growing confidence in fixed income instruments in emerging markets. Now, the other thing that's happened is that, of course, some pension funds are stuck because their boards are telling them, look, I don't want to take any currency risk. I don't want to take any risk, counterparty risk. I want to be in U.S. Treasuries. So they're stuck at 1% or less interest rates. So what they're doing is saying, okay, 90% of my assets will be in this kind of thing. I'll put the rest in something that's really risky and with a high volatility in the hope of getting a great return to make up for this terrible return I'm getting on the fixed income instruments. So what do? You not only go into emerging markets, you go into frontier markets. So 3 years ago, we started a frontier fund. We started one in Luxembourg, and one in the US, and one in Canada. Of course, when we start a new fund, our parent company seeds the fund. They put in 10 million or whatever. And I thought, oh, we may get to 100 million, maybe, if we're lucky. We're now at 2 billion in frontier markets funds. Why? Because people are looking for this return, because they know, of course, frontier markets are growing at a much faster pace. Their perception is very risky, because if you look at our portfolio, what's the biggest country? Nigeria. Yeah. Then when people ask me, what are you investing in Nigeria? I say, I'm investing in banks. Banks in Nigeria? I just got a letter from a guy who claims he's a government employee, and he's, what the hell are you guys doing? But they don't, because when you get on the ground, you realize the banking in Nigeria has been cleaned up. They arrested, threw a few guys in jail. They're watching it very carefully and so forth and so on. So it's a good opportunity. But this is the kind of thing, you have to overcome the perception. Second largest country, Vietnam. Vietnam, there's no liquidity. You can't buy anything and so forth. But very cheap. So you gradually, little by little, you gather Vietnam stocks. What's the next one? Kazakhstan. Dictatorship. What is this? No, but Kazakhstan's got a very profitable oil company, Kazmunai Gas. What's the other country? Turkmenistan, another oil company, Dragon Oil, doing very well, very profitable. So these are the kinds of things that, frighten people, but the reality is that the returns are very, very good. If you look at our portfolios, you'll see there are two themes that seem to come out. One of them is consumers. There are over 5 billion people in emerging markets versus 1 billion in developed countries. The emerging markets populations are young, so they're entering the most productive years of their lives. So we are very interested in capturing that consumer demand that's coming forward. So therefore, we're looking at, first and foremost, consumer banks. Because if you look at Africa, for example, and many other countries in emerging markets, it's very underbanked. They're not, not many people have bank accounts. It's not surprising to find that more than half of the people don't have bank accounts. So there's a tremendous growth prospect. And credit cards just coming in. Not only products, of course we're investing in clothing companies, retail companies, and so forth, but the actual software and the service side of consumer is very important for us. So that's one theme that you'll see. The other theme is commodities, because we believe commodity prices will continue to trend upwards. Just to give an example, currently the number of automobiles being sold in China has surpassed that of the United States. The United States heretofore has been the largest single automobile market in the world. Now China is the largest. And by the way, continuing to grow. Every automobile needs palladium or platinum, because you have a catalytic converter that needs that as a catalyst, either palladium or platinum. So we want to be in palladium or platinum. Iron ore, copper, you can name it, it's all needed. And now when you get into agricultural commodities, you'll see the demand has been increasing, because what's happened in the past, a Chinese family would get their protein from soybean curd, soybeans, soybean milk, soybean curd, so forth. Now they want meat. If you want to have the same amount of protein, you need roughly 6 to 10 times soybeans, the value of soybeans into meat. So you can see this incredible demand. Then you have sugar. Sugar price is going up. Why? Because it's being used for alcohol. Because with the high price of oil, now countries like Brazil that can grow a lot of sugar can convert the sugar into alcohol, ethanol.